Everyone agrees on who caused 2008, and the agreement itself should worry you. Ask anyone what caused the crash, and you'll get the same answer. Subprime mortgages, reckless homebuyers who borrowed more than they could pay back, a house of cards built on bad loans to bad borrowers. It's clean. It's simple. It fits in one sentence. That should have been your first clue. Subprime loans made up a small slice of the total mortgage market, not the whole cake, just a few burnt crumbs at the edge of it. Not nearly enough on their own to torch a $15 trillion economy. So if that's not the fire, what actually was? You pictured a struggling family signing papers they didn't understand. That image is comfortable. It's also convenient because it keeps the blame pointed downward at borrowers and away from the people upstream who built the machine those borrowers walked into. Here's what actually detonated. After the loans were made, Wall Street took thousands of them, good, bad, and ugly, blended them into one giant financial product, and sold the whole batch as safe. It's the financial version of a butcher grinding expired meat into premium sausage and slapping grade A on the label. It should have collapsed on inspection. Somehow, it didn't. Then the rating agencies, the referees whose entire job was inspection, stamped it AAA, same grade as U.S. Treasury bonds. Nobody double-checked the referees. Which raises a much scarier question. If the referees were they wrong by accident? You're one click from finding out how deep this actually goes.
There was a financial instrument in 2007 so poorly understood that even the bankers selling it couldn't fully explain what they'd built, and it was already unraveling in the dark, months before anyone noticed. It was called a credit default swap. Picture buying fire insurance on your neighbor's house, a house you don't own, have never entered, and have no stake in surviving. Now picture 40 other strangers buying that same policy on that same house. Nobody questioned why insurance without ownership was legal. It sounded technical. Technical sounds safe. It wasn't. Here's the number documentaries tend to gloss over. The total face value of these side bets swelled past $60 trillion, bigger on paper than the entire planet's yearly economic output. On paper is doing a lot of work in that sentence, and remembering that detail will matter later. You didn't cause this, but you paid for it, through your job, your retirement account, or someone in your life who lost theirs. When the housing bubble finally cracked, the damage didn't stay in housing. It moved through a web of promises so tangled that no single company, not even the ones who wrote the contracts, could see where their own exposure actually ended. Lehman Brothers didn't collapse because of one bad call. It collapsed because it was sitting at the center of that web, owing money that was itself insured by more money that nobody could locate fast enough. The regulators had the paperwork the whole time. They just assumed no one would actually be reckless enough to build this. When Lehman fell that September, the world assumed the story was over. It wasn't. That was the smoke alarm, not the fire. The actual blaze started somewhere nobody was even watching.
Here's what most documentaries leave out entirely. 2008 wasn't purely an American failure. The first domino was pushed from 10,000 miles away. For years before the crash, countries like China, Germany, and the oil-rich Gulf states were saving at enormous scale and parking that money in American markets, chasing safety. Economists gave it a name, the global savings glut. You've never heard the term. You've absolutely lived the consequences. That flood of foreign cash pushed American interest rates artificially low. Cheap borrowing meant cheap mortgages. Cheap mortgages meant more people qualifying for loans they couldn't actually sustain. The world funded the fire before America struck the match, and nobody sent an invoice for that part. So here's the reframe. 2008 wasn't one broken system, it was 3 separate failures. Risky lending, invisible insurance bets nobody could price correctly, and a global wave of cash nobody thought to question, arriving at the same address on the same day. One villain makes a tidy documentary. 3 converging failures makes a true one. Historians tend to pick the version that fits in a chapter heading. The real discomfort isn't who's to blame, it's that no single regulator, CEO, or government could have stopped this alone, because everyone was staring at their own piece of the puzzle, and nobody had the whole picture in front of them at once. And here's the part that should sit with you after this video ends. Nothing structural actually changed. The capital still flows the same way. The products are still complex enough that most buyers don't fully understand them. The referees still get paid by the companies they're grading. The fire went out. The wiring didn't. You just can't see where the next spark is sitting.